All right, let's dive right into this explainer. Today, we're doing a bit of on-chain detective work because we're looking at a massive contradiction surrounding the Core DAO token, or just Core. On the surface, the numbers for this project just do not add up. So we're going to dig into the data, review all the conflicting signals, and try to actually solve what has become a very real crypto mystery.
So, to make sense of this, we got to start with the main event, March 30th. Out of nowhere, the price of Core completely craters. I mean, we are talking about a brutal, catastrophic 53% drop in just 24 hours. For anyone holding the bag, that was a devastating fall off a cliff. Now, you know as well as I do, microcaps swing wildly every single day. But for a major, established token with significant capital behind it, a 53% haircut in a single day is an absolute catastrophe. It destroys trust, and it wipes out millions in perceived value almost instantly. But a simple price drop, even a really massive one, isn't actually a mystery on its own.
But here's the catch, the real paradox here. At the exact same time the price was falling off that cliff, the trading volume for Core didn't dry up. It didn't just bump up a little bit either. It explosively spiked by an incredible 103%. It literally more than doubled. If you've spent any time analyzing market dynamics, you know that a catastrophic crash paired with an explosive volume spike is, well, it's bizarre. It really begs the question, what on earth was happening behind the scenes?
Section 1. Anatomy of a crash. Let's decode the blockchain to see what actually caused this event.
Right away, two totally conflicting stories emerge. On one hand, you've got the official explanation from the Core DAO team. They're saying, hey, this was simply a market-driven event. Their explanation was that large sell orders triggered a liquidation cascade. To put it simply, that's just a domino effect. A price drop forces automated sell-offs on lending platforms, which pushes the price down further, triggering even more sales. Standard stuff, right? But the on-chain reality told a completely different story. Independent observers tracked the blockchain and zeroed in on one single massive wallet. This whale deliberately dumped almost 3 million Core tokens right before the crash and then just proceeded to liquidate almost everything they had left.
And to put this into perspective, during this crash, the trading volume didn't just double. At its peak, it exploded to 203% of the token's entire market capitalization. Think about that for a second. The trading volume was twice the total value of all the tokens in existence. For market analysts, a number like that is a blaring red flag. It points way away from some random market panic and heavily suggests a coordinated, deliberate sell-off.
Moving on to Section 2, the value trap dilemma. Are we looking at a massive bargain or a really dangerous trap?
To understand the risk here, we have to talk about the concept of a value trap. Basically, a value trap tricks you, because on paper, it looks like an absolute steal. It's trading way below its all-time high. But the catch is, the market actually hasn't made a mistake. It has correctly priced the asset for a bleak future where it's just in a state of permanent decline.
There's this perfect metaphor for it. A value trap is like an ice cube that's just sitting out in the sun. Sure, when you look at it right now, it still has some substance. It looks pretty solid. But its core is actively shrinking, and it's only a matter of time before there's nothing left but a puddle. As an investor, you might see a massive drop and think, oh, I'm buying the dip, I'm getting a clever bargain. But actually, you're just catching a falling knife. You're buying something on its way to zero.
Which brings us to Section 3, bearish signals versus bullish growth. Let's look at the actual conflicting signals on the ground as of May 2026.
Now, on the technical side, things are looking remarkably heavy. If we check the major moving averages, like the 50-day simple moving average sitting at roughly 4 cents, the 200-day at roughly 10 cents, and the 50-day EMA, they are all, across the board, overwhelmingly flashing sell signals. And this is critical, because when short-term averages fall below long-term ones, it doesn't just spook human traders, it triggers all those algorithmic trading bots to dump their positions too, compounding the pressure into a vicious cycle. Plus, recent analysis notes that Core is currently suffering from a broader capital outflow across the whole altcoin sector.
But hang on, because counter to that, the bulls have some incredibly strong fundamental evidence. While the price might look terrible on a chart, the actual on-chain growth tells a story of massive adoption. The total value locked, meaning the real hard capital committed to the network, has shot past $850 million. And we're not talking about empty volume here. There are huge amounts of Bitcoin and Core tokens being actively staked. When users stake their tokens, they're locking them up for a set period. They're actively refusing to sell because they believe in the long-term utility of the network, which actually restricts the available supply and provides a massive bullish counterweight to all those technical sell signals. Section 4. Long-term price predictions. Where is Core headed when the market is this completely divided?
You can see this total uncertainty perfectly reflected in the wildly diverging forecast from major analysts. The bearish models, they foresee the token bleeding out, predicting it will continue to fall and just languish in the 3-cent range as capital rotates away. And let's be real, a drop to the 3-cent range isn't just a dip, that is near total annihilation for the project's market standing. But then the bullish models look at that $850 million in locked value and predict Core could actually skyrocket, reclaiming the $1 mark or even higher. That's a massive moonshot, showing just how fractured the current market consensus really is.
If we zoom out a bit further and look at CoinDex's long-term prediction models, they're outlining some staggering return on investment potential if the bulls are right. We're talking estimates climbing to around 11 cents by 2030, 21 cents by 2040, and over 51 cents by 2050. That would represent an ROI of over 1,200% from current levels. But again, that entirely depends on whether the fundamental network growth can actually overpower the current crushing technical trends.
So let's recap the clues. We started with a highly suspicious whale dump that triggered a 53% crash. We looked at the overwhelmingly heavy sell signals from the moving averages and the broader altcoin outflow. But we also weighed that against the undeniable reality of $850 million in locked network value and massive staking participation.
Which leaves us with one final, burning question for this explainer based on all this evidence. Is Core a fundamentally strong project that's just temporarily mispriced, making it primed for an explosive rocket ship recovery? Or did that orchestrated whale crash expose a fatal flaw, proving that it's nothing more than a melting ice cube and the ultimate value trap? The data's all right there. The rest is up to you to decode. Thanks for joining me, and as always, keep your eyes on the chain.